Guys, good afternoon, welcome. Hope you're all okay. How is everyone today? How was the trading? We managed to make a little bit in the cable, didn't we, today? But other than that, quiet with the trading. How are you, friends? Bottle Torch, Intake, Mateus, Kay, and Solomita. How are you guys? Everyone okay? Good, good, good. How's the trading gone today, guys? Have you been up to much? You typing? Didn't manage anything. Mateus watching that euro dollar. Yep. Non-existent. Okay, so yeah, it is August, guys. It's summer holidays. Don't beat yourself up. Cable was a bit of an opportunity. You had to really scalp it, though. It's been a bit whippy. Anyway, guys, we're going to crack on. So, in response to a couple of questions I've had in the trading room, I thought it'd be good for us to sort of talk about aspects of trading. Straddling is one of those. I believe Igor, who isn't in the room now, strangely, has asked about this. So I've put a few things onto a slide, tentative, few just slides, and we're going to talk about that. And then we're going to look at this Trendline strategy, because I believe, Mess, you asked about this one, didn't you? It's Trendline accelerator strategy. And it's one that I've used multiple times, generally in my own trading. I use it less than I do now, and that's because I've sort of evolved, and it is one of these strategies that does require a bit of discretion, and obviously you need trend lines. So for the people who are looking for sort of quick moves and quick momentum based moves, it's actually quite good. Generally use it on a 5 or 30-minute chart, and we're going to talk about that during the session. But we're going to start with our straddling. So first things first, though, disclaimer time. Spread bet in FX and CFD trading carry a high level of risk to your capital and can result in losses that may exceed the initial deposit. The trading of these products may not be suitable for everyone, so please ensure that you understand all of the risks associated with trading. The information and comments provided herein under no circumstance are to be considered an offer or solicitation to invest, and all information provided is believed to be accurate at the time of production. Nothing herein should be construed as investment advice. Information provided within this room is the personal opinion of the moderator and not Tradimo, that's me. And this content therefore does not constitute financial investment or tax advice, and Tradimo does not accept any liability for the content of or comments made during the session. So now that is out of the way, let us crack on, shall we? Not out at the moment. There we go. Okay, we'll start with straddling, guys. So we talked about straddling before. How many of you guys have actually seen me straddle in the trading room? I know that a few of you have, because we've done it with some Canadian and some other data. Bottle Torch, and it's been generally successful, hasn't it, Bottle Torch? It's been something that's pretty good. We've had a pretty good session there with our straddles. Generally, it's a very easy thing to look at and say, well, yeah, there's no problem. We can straddle on it, and it's not that easy, guys. Okay, straddling the market, as we already know, is there's sort of 3 types of straddling available. Okay, now the one we're going to be focusing on are these 2 here, or more importantly, this order here. Now, straddling, typically one of a number of trades. Options trading, definitely not the straddling that I do, guys. Options trading, basically you're buying the puts and the calls thinking that a market's going to go one way, and you're hoping for the market to basically move massively past a strike price, the same expiration, same strike price, and you're looking for it to just move miles through, and obviously you'll lose the one side of the option if the market obviously goes up or down, but the other side you'll actually win on, and with options basically it's a case that you only lose the fee obviously that you plonked out for the option. Worst case scenario, if neither of them sort of make it through, you are looking at losing the fee on both of those. So quite limited risk with potential big upside, and that's the general nature of straddling, guys, even with the forex and outright sort of straddling. Straddling, as we know, is literally basically popping an order in a chart over news. So if we actually look at cable's a prime example today. Pop it up on the chart. We know what it is, don't we, guys? Okay, it's before news comes out. So we come to the market today. We're around here. And basically what you're doing is just before the news event, and again the news event we've had, so let's pop it back, you're basically putting a sell order and you're putting a buy order above and below market. So generally what you'll be doing is you'll be using the stop, pending order, you'll be using buy stop and sell stop. Okay, and When it comes to the straddling, basically the idea is you're hoping that the market has such a big move that you get filled without having to try and click the button, because as we know, there's a lot of computers. It's very hard to get your trade execution off, particularly some of these retail brokers. So people will work orders, and it used to be a very, very low risk way of trading. A lot of people used to make fantastic returns doing this every month. However, the issue you've got now is brokers have kind of wisened up to this. They start widening spreads. You've got slightly less volume in the market now, and what that means is, it means that potentially nowadays what happens is you put an order in to sell here, but obviously because of slippage, you get filled down here, okay, and the value from that trade goes. So straddling has kind of become a bit harder these days. Now, it's not as simple as just popping in an order, guys. There's a number of considerations that I use for straddling. I don't bore you with every single bit of detail. I generally just feel, it sounds a bit silly, but I just feel the market now when it comes to the straddling. So if we pop back to the slideshow, there we go. Okay, this is what I generally focus on, guys. Straddling an order. A lot of traders used to basically put a buy trade and a sell trade on. They used to have a long and a short going into data, and the idea is the market moves up and they get out of the sell trade if it's a very big bit of data. So if you get like that CPI today and you think that cable is going to keep moving, you would have bought it and sold it before the figure, and you would got out of the buy side of it very, very early. However, guys, I generally don't like doing this. There is an argument to say that it's very good. Why do we think it's a good argument, guys? Have you got any ideas as to why some people like to do it? Any ideas at all? Bottle Torch, Mateus, Brenda, Solomito, Sola. Any ideas why people prefer to do it, doing it to putting a stop order in? Mateus and Brenda both type, and we've just discussed it. They want to trade without slippage, absolutely. To limit, yep. They basically want to get in the trade without slippage. The risk is, though, that you end up with two positions on. The market moves very, very little. For example, let's say that you entered into a long trade and a short trade here, okay, and we can see that we've actually got, excuse me, I've got fat fingers today, guys. But what the danger is you end up long, you end up short. Why is this moving? Sorry. Let's pretend this is the news here. The market doesn't actually move very far because the data's in line, and then you're stuck with a trade where we're literally just, losing on either both sides because of a spread, so we could be losing in the middle, or you're losing on one side heavily, and there's not really any chance because there's no sentiment in the market. You end up with a market that could just move sideways. Okay, so there's sort of pros and cons. I prefer to use the straddle here, this sort of straddle where we just work an order, and I prefer generally to focus on one side of the market. I straddle with one position, and it's a stop order, okay, guys, and there are some very, very specific things that I like to do with my straddling. You've seen it, and we've briefly discussed it. One of the things that I like to do with the straddle, and we can see a good example of a long and short straddle here, is the sentiment in the market. Generally, if you're in a daily trend, okay, and there's a reason, we can see we've got euro here, there's a reason that the market should be moving lower for whatever reason, and we've maybe had a little bit of a pullback, okay, like we see at this level here. If we're sort of trading like this, and there is a sentiment, there's a reason for being in a trade, and there is a pullback, and it's a big piece of data, look to enter with the trend, with the fundamental. The only problem is, guys, you shouldn't be getting involved when the market's heavily overbought and oversold, because the market can be very, very choppy. Generally, there are examples of a market hitting very, very overbought and oversold levels, and you end up getting yourself into a bit of a pickle because the market doesn't go as far as it wants. So when it comes to picking the market, make sure you're picking a market that's not overbought. If you can go with the trend or look at the bigger picture on the daily, very, very important. Okay, very, very simple. And again, we're just going to be very brief, and then we're going to have a look at this trend line strategy. Okay, the other thing, basically, if sentiment isn't biased, you can still look for the trade. Now, how I generally do my straddling is, so on the daily, say we're in a range, okay, like the dollar yen, for example. If I'm know that we're in a range in market, okay, generally I'll have a little look to see if there's a big move before market. We already know that there was a very, very, very you know, interesting move in cable before we had the actual numbers come out today from the CPI. We see that actually, you know, before the figure, guys, if we take this morning into consideration, and it's a little bit odd that, you know, oh, look at this, guys, a little bit early, you know, before the numbers out, just you know, an hour or so, the market came off 30 pips. If you get sort of a move, and let's pretend that cable wasn't heavily, you know, but bearish by the looks of it right now, and I actually think that cable should get a bounce at some point. So, you know, I'm not massively bearish cable. Okay, well, I wasn't until we had the CPI. We moved down. Okay, the value trade now is, look at the chart, we're oversold. There's no value trade in being short on a CPI figure unless, you know, it's a very, very mucho low number. And we did get quite a big move today, but generally I think that move was a little bit over exaggerated myself for a number at 1.6%. But anyway, that's just my argument. So generally look for the straddle to go against this trend, because as we already know, guys, people are now expecting a worse number. Okay, definitely expecting a worse number. If we get a number that's in line, or if we get a number that's slightly better, or even a lot better, you know, this market's going to retrace. These shorts are going to be getting out very, very quickly, at least on the short term. And again, we're only looking to take advantage of a short-term move. We're not looking to hold a trade forever and ever and ever. It's very much a short-term momentum move. So, you know, the way to do this is to literally have a little look, okay, at the move that we've had. And we can see from 9 in the morning, we had a 37 pip move. We know that cable has a 52 pip average true range because we went through that in our session earlier. If we've had a 25 to 50% move of the average true range on the daily, and this is specifically for these markets, guys, that are very, very low volatility, just so you know, that's a rule board in just for the volatility. And it's something you can apply discretion to. Generally, what you can do is pop a straddle, and it will depend on the number. Okay, and we'll talk about the numbers we should be doing at the end, but pop the straddle at least, okay, 1 to 2, generally 2 times, whichever time frame you're looking at. So this one would be 9 pips with a 4 pip range there. Generally, I like to use, and I'm going to be honest with you guys, I like to use a half hour chart initially. Because you get a better average true range, so you know you can use 1. So if we have a look here, the average true range is, holy moly, terrible, it's 5 pips. So 10 pips is the average true range. Okay, we'll pop the straddle 10 pips away. Okay, so we can see we're at sort of 86, just pop it up at 96. Now, 1 minute or 2 minutes before the data comes out, you've got to be very careful, because the market, and you've got to be ready to drag the orders away, guys, and you've got to have a quick system, because the market a minute before big data, and this is for big data only, straddling, you know, guys, it's going to be very, very illiquid. You're going to see, you saw it today, there was like a move all the way back up, and then it come down, and it was just hell, okay, because of the volume. So you've got to make sure that it's far enough away. Now, generally, you know, if there is a little bit of a level nearby, maybe just pop it above a level where there can be stop losses, things like this to consider. Okay, so we pop in the order, okay, and it's very, very simple. Okay, you're just waiting now for the data to come out. In this instance, we actually got a really low number. I still think that was an over-exaggeration of a move, but, you know, we've continued lower. We didn't buy it. We just scalped a few. I think we scalped about 11 pips in the market, made about 11 pips, and we were happy with that. But generally speaking, you know, we want to take advantage of these moves. If we look at dollar CAD, you know, dollar CAD is a prime example of a trade. Here we go. Dollar CAD. Okay, we all saw this one. This was one we had in the trading room. On the daily, okay, I was uber bullish dollar CAD. We had a nice sort of hammer. We were around a support level, and we had some really big data. We had some employment data that was coming out in the market. Okay, and that was about sort of a week and a half ago. There we go. It was actually here on this day. Now, before the market, before the move, we can see that going into this figure, we actually had some dollar weakness. Now, I'm bullish the dollar, and we were trading sort of around a little bit of a support zone. You can see quite here. Okay, we have a little look. You know, what have we had? Well, we've had a 30 pip range, which I know is over half, or is around half the CAD ranges that we've been having. The average true range in ticks. So you put it 10-15 pips away at the start of the number, so you know we're trading at around, let's say around 13-14. We popped our order in at 26. We had it here, and this is something that you know was in the trading room, guys. You can see this quite clearly. So we had our order in the market, okay, a buy order, and the idea was, you know, if people are wrong, the market is going to move up. But if the number is in line, okay, we're far enough away to avoid the market just blipping us and up on us. As well as that, we had the RSI as a support mechanism. And what happened? We got a terrible number, guys. We had very little slippage. We got filled. I think we got filled pretty much at 28.728, and the market immediately went up 50 pips. Now, this was a huge number. Again, if there's levels, sort of single prints on the way, you can use those as a potential target. We see we filled the single prints perfectly here, pretty much. And generally, you can use that to sort of give yourself profit targets and things. And again, very, very quick guys, you know, generally don't like to hold the trade for too long in case we retrace. So with that straddle, you know, a very, very good example of us making some money. And again, things like inside days, you know, on a Friday, if we're having an inside day on a Friday and we haven't broken the prior day's high or low, which we hadn't done actually in that CAD trade, you know, the market doesn't like those. So things like that are bear in mind. So, you know, if we start breaking towards a high or low, there's a good chance we're going to get filled there, so you can use that for the trade. So it's about the value trade, guys. Using the ATR is a good way to do things. As well as this, just moving on swiftly so we can get onto our trendline strategy, and I can show you this quickly. Okay, the straddle should always be sort of 1 to 2 ATR. It should never be too close to the market, guys. Okay, you don't want to get triggered early. You know, I've been there, guys. I've spent years and years and years straddling. Okay. Learning. It's not about just putting an order into the market. It doesn't work. Igor's a good person for this. He said he tried to straddle. He lost 30 pips. You know, there's lots of considerations. There's the sentiment of the market. There's the data. There's how much the market's moving at the moment. Is it, you know, is this a precursor to something bigger? You know, there's lots and lots of considerations. Is the market overbought? And gradually you just hone the skill, hopefully, to do this. You know, the straddle should only be used in high volatility events where no revisions take place. Never straddle, never ever straddle non-farm payrolls, guys. I've seen people get carried out where the revision and the unemployment rate is different to the headline. The market blips up, it blips down. The three that I generally focus on, and I don't these aren't exclusive to countries, but things like GDP and employment, very important. Things like CPI, important, not so important in the US. The more volatile the event, the further the stop into the trade should be. So, you know, if it's a first reading of GDP and people are putting a lot of emphasis on this, we should definitely, you know, make sure that that stop is maybe 2 to half ATR. Again, though, it's about estimating how far you think the market's going to go. And the only way you're going to do that, guys, is by actually watching how markets react to news events. I know for a fact 50 pips in cable on CPI after we've come off 35 pips, you're probably going to have wanted a 0.2 below read for that. You know, things like this. And again, practice and watching these things and looking at it on demo accounts is a way forward, although slippage might be a bit of an issue. Okay, employment's always a good one, but not non-farm payrolls, guys, and potentially ADP, but not generally ADP. Okay, never straddle in a live market both directions. I do not straddle both positions. A lot of guys did or used to. I never have the trades open, especially with a retail broker, guys, because the spread will kill you. Trust me, you'll get killed on the spread, especially with variable rate brokers. You know, as I say, you can use stop losses for straddles. So, you know, you can put a stop order in with a stop so that when it's triggered, the stop loss goes in. Generally, don't like to do that myself. Reason I don't like to do that, guys, I'll do it with a profit target, but I won't do it with a stop loss. And do you know why I won't do it with a stop loss? Again, spreads, and also the fact that the market can blip up, blip down. It's very volatile. You don't mind if your profit target gets hit, but you know, the amount of times you see a market go up, come back, and then go up. So again, I generally will put the profit target potentially in, but not the stop loss. As well as this, guys, Broker considerations for you, OCO orders, one cancels the other. So if you have a buy and a sell straddle and you want to do that with a stop in and buy stop and sell stop, OCO ensures that you're not filled on both orders. So if we blip up and blip down, you should get filled on the long and not the short. Slippage is huge. There are some very, very good brokers out there for slippage. I don't know what your slippage is like, guys, but I found a couple of very, very good brokers out there. We can have a chat about that at some point. DMA, direct market access, is one way to avoid this, but generally DMA will cost you, you've got to have X amount under deposit because it's direct market access, and generally Forex, it's more futures, it's not cash currencies as such. If you've got an STP broker though, a true STP broker, you might be okay. Trying to look at fixed spreads, that's the way to help things. Again, straddle liquid markets, but euro, cable, things that move around a bit as well. You don't want to be really trading something that isn't moving around or doesn't look likely to move around on the figure. Things like dollar yen were reacting well to news. They're not so good now though, guys, are they, that dollar yen? So bear that in mind. And things like guaranteed stops, or some brokers, I think it was Forex Club potentially, they offer you a limit to how much slippage you take. So on an order you specify 10 pips, 50 pips, and if actually the market blips up, instead of just filling you on that stop order you've got, it will actually just cancel the order. Okay guys, so that is pretty much straddling. Do we have any questions on this? We did discuss this earlier, but I wanted to put something a little bit more solid into things. And again, when I do straddling in future, I'll maybe take you through a few of the rules a little bit more. You see me just put the orders in and explain a little bit. Maybe we'll go by step for this. Any questions or anything, Bottle Torch, Brendan, Mateus, Sola? See Bottle Torch and Mateus. Have any of you ever straddled a market before, actually, with consistent success? It's not something I recommend for beginner or beginner intermediate traders. Okay, I know you guys are more in the intermediate class now, but still not something I recommend. Yeah, absolutely. Again, it's knowing which market, it's knowing the data as well, guys, and sometimes it's things like IFO are good for straddling. Most of the time, you maybe don't want to do that. Michigan used to be great for straddling, not so much now. So you've got to be very, very much up with the bigger picture as well. It is, but it's trading's an educated guess. A lot of the time, guys, you've got your fundamentals and your technicals to help you. But you're still guessing which way the market's going to go. Straddling is a little bit less sort of intuitive to the fundamentals and technicals of the market, but it is quite technical. Looking for levels around there, looking for the value trade, but there's always that luck element that the data is going to come out and so on and so forth. So it's still educated. Straddling the market is still educated. It is still more of a gamble, but once you practice it, and you find sort of the niches, you can significantly increase your odds. For example, guys, we've had a few straddles in the market, haven't we? And I think we've only lost on one, I believe is the record, particularly recently. I think we lost about 8 or 9 pips on a straddle, but we've made as much as 40-50 pips on them. So guys, it's very difficult to do. I don't recommend anyone does it, and if you are going to try it, use a demo account and practice. Right guys, anyway, Trendline strategy. Who wants to learn a little strategy of mine? And it is actually one that I was writing up. I've had a little look to see if I could find the PowerPoint for this, but I couldn't, and I didn't unfortunately have time to put anything together, guys, because obviously this came up sort of middle of this morning to afternoon. But basically, guys, the Trendline strategy is a very, very much my strategy and something that I've put together. We've actually had an example of one of these today in this euro, in this dollar CAD. Sorry, well, I say today, it was very, very very, very early this morning, but it was today. And this is the example that I want to use. Okay, so basically, the strategy itself is based on taking very quick sort of amounts out of the market. The way we do this is we do this by using the accelerator indicator. Okay, guys, how many of you have ever used accelerator indicator? Have you used it before? Bill Williams, it's one of his 5, 6 indicators that he's got. This one here, red, green, one of them. Okay, and the idea is there are 2 types of trendline trade you can take. There is the trendline continuation trade that we talk about, and I talk about it all the time. Again, I don't always go into the details that I maybe should. You know, I don't always say, listen guys, take the accelerator, but you know, the trendline strategy is predominantly on the accelerator itself, and trendline breaks. Now I like the trendline breaks myself, guys. Can anyone think why trendline breaks, given what I've just said to you about taking quick money out of a market? Any reason? What is it? What happens when a level breaks generally? Yes, you know me guys too well. Volume and momentum. Okay, absolutely right. And yeah, looking for stops, things like this, you're absolutely spot on there. This is what makes you happy. Well, winning 139 million on the Euro Millions would make me happy as well. And it would make everyone in the trade happy, because I'd make sure that you all had a nice present or something as well. So cross your fingers, buy you all Ferraris or something like that, as a way of saying thank you for attending the room. And I'm a man of my word, it's on record now, there you go. It might be because I'm a lunatic that I like momentum. Who knows? Who knows? Maybe I'm mad, maybe I'm not. Anyway, guys, so the strategy itself, and again, discretionary, but this is, I love this strategy actually, and I'm going to probably start trying to trade it in the trading room with you guys. The idea that is, it's very discretionary because you have to use trend lines. So generally when you're drawing a trend line, guys, or a continuation pattern, it works for as well. Again, we're looking for sentiment in the market. So again, I'm very much bullish this dollar CAD. I think this dollar CAD goes up. If you can get a daily bit of sentiment, it will help you. Okay, so with this example today, it's very, very simple. We look for a trend line to form. Okay, and the idea is, like our other trend line strategies and everything else we use, there's got to be 3 points, but it hasn't got to be 3 points where it's, what's it got to be, guys? What do we call them? We don't call them points, we call it clusters. Yes, I like to call it clusters, and it's very, very important. And the idea is that basically when we form a trend, as we already know, it's very easy to draw a trend anywhere on the chart. But a good trend will have it will form a point, move up. It will form another point, and it will move up, away from the level. Now, generally, the further away that you move from the level on the first to the second point, and then the second to the third point, the better the trade is likely to be. Because the problem you've got is when a trend is moving around a level, you're eroding the level. Okay, so in this example, we can see that we've had 2 points. We've had a big move away, a big down. We've had a little bit of a bounce, and now we're looking for the third cluster. Now, for me, look, technically we have 1 point, we have 2 points, we have 3 points. That's not a 3-point trend. That is a cluster for me. What I look for is a few candles either side where the market has maybe traded once or twice, because that reinforces the trend as well. If you have a few clusters, that's quite good, but not too many. Generally around 4 or 5 is enough. So we can see that we have a cluster here and a cluster here. So we actually now have a potential trend continuation trade. Okay, different. Do not get it mistaken with a trend breakout trade, which we're going to have a look for an example of at some point. So we can see we've got 2 clusters. We're simply looking for the third cluster. Okay, so we move along, and you can see we're moving away from the trend. Now, generally, guys, there you go. There. Now, generally, guys, just be aware. I don't like markets where we hug the trend, but I will still take them based on the candle that happens before the third point. So the rule is very simple: 1 cluster, 2 cluster. We wanted to see this really move away and come back down. Now, on this particular candle here, the candle where we actually confirm the trend. What you're really looking for, guys, is, or even here we could, this is another trend line trade. What you're looking for is you're looking ideally for a candle that opens, you know, at least one average true range away. 4 pip average range, we can see that we're actually 8 pips away. And a candle that extends itself down, okay, touches the trend, okay, and then we basically look to jump into action. So as soon as we touch the trend, you have a choice for the continuation. You can enter aggressively. You can be very aggressive if you want. It's entirely up to you. Or you can be conservative and actually wait for the bounce to at the end of the candle. Okay, so you can actually enter here. I myself am aggressive, you know I'm aggressive, so you can enter either here or here. We're going to enter here just for argument's sake from today, because we know that we have the trend, we have the third point. Okay, now from here on in, we are actually going to be relying on momentum, and this accelerator generally works best when we're in big sessions. So this is going to be a trade that, you know, you've got to be very careful of here, okay, because generally if the accelerator is very, very weak, that tells you the market is very, very much quiet. Whereas if the accelerator is like this, that's nice. We like to see things like that. Okay, nice, steady, gradual slope up, and so on and so forth. So guys, again, it helps if you have sentiment. I have a bullish sentiment. Technically, we are moving down though, so maybe not the best idea to take this trade, but it is an example that would have worked. From today as well, so you know we're not curve fitting. So we have the order in. The stop loss, basically, guys, goes below the trend. Use a bit of discretion again, maybe one average true range initially, but we're not going to be holding, okay, we're not going to be holding the trade all the way back down here. We just want a stop loss in case something happens for momentum. Okay, so you pop the stop loss below. Okay, the trend line again, good support level, and if you like, you can track. Okay, you can track the trend line, but generally these trades don't last long time. So you know you might want to just hold it in place. So we look at the accelerator once we've entered into the trade. Okay, once we look for the bounce, and the key is we're looking to see, okay, in a long trade off the uptrend, whether or not we're above zero. If we're not above zero, it's absolutely fine. We're not worried, because what we can do is still take the trade. Now, what we're looking for is, and we'll take this bit because this is very, very tight. You might not be able to see this, but we're looking for, if the rule is, if I was zero, okay, we have to make higher lows on each of the preceding candles on the accelerator. If we don't, we exit the trade. And the reason is because generally we need to be able to track, you know, track the movement. We don't want to be in the trade too long. And again, if you're in a downtrend and you get a bounce off the trend or a break, and the accelerator moves against you, generally, you know, that's telling you that the market is a bit fruity. It's not doing very much. Actually, there's a good example of the accelerator here not making the, where are we? Not making the higher low, but I'm just trying to find it. Anyway, okay, so that's one of the rules. We make a higher low until we hit, there you go, this is an example here. We make a higher low until we hit above zero, and we can see at this point we're just sort of above zero. Okay, once we're above zero, or if you enter the trade and we are above zero, the rule is simple. You're going to either exit the trade when the stop loss is hit, the trend breaks, or you're going to enter the trade when this accelerator moves below zero. And in this example, we can see we stay above zero, we begin to move on side. Again, you can use reversals if you like. We're above zero, we're below zero here. Okay, so very short term, guys, you know, and generally I prefer the breakouts because then we get momentum. This is why the continuations work, but generally you will breakouts because that's where you get big candles and big moves. So in this example, we can see, oh, we made a grand total of about 10 pips. Okay, and then we can see that actually the market continues to have a little bit of a bounce. We hit the oversold. You know, we had one candle below zero. Variations are that you leave it for 2 candles below zero. I generally just get out after one, but again, if you had left it for 2 candles, you'd actually still be in the trade. Now, guys, you would have seen the trade pretty much up as much as 27 pips. Obviously, trading as we are now, it's a little bit higher based on the data. Okay, so actually, you know, again, you'd still be in the trade. Okay, and it's these sort of moves we really like. You'd be a nice 40 pips on side. So that's the trend continuation. version of the accelerator. Do I have any questions? Anyone got any questions so far? Anything at all, guys? And again, it does help if you're in a little bit of a longer term pennant or triangle like this. Yeah, stop loss under the trend line. Again, I leave it to you to use a bit of discretion, but generally, guys, you know, I monitor it very closely. That's the one thing about this trade I will do. Volume, very important. You know, it's nice to have volume. Okay? Yeah, maybe one ATR. The thing is as well, you know, this is an example from today where, you know, I probably would have risked very little. You know, I'm not going to lie to you. I wouldn't have risked 2%, 1%. I'd probably have risked, you know, even just 0.3 to try and nick, you know, if I can make 1% on the trade or even 0.5% on a quiet day ahead of the data. I'm happy to do that. You know, the real thing is you want to see good bounces off the trend. You know, this is a good example here, guys. We have a bit of a downtrend from a swing high. Again, swing high is very important for finding levels. We have one cluster, and I love these. These are really good because that's a cluster. That's a strong indication, these things here, that, you know, a trend's gonna hold, or when it breaks, it's gonna break big. You know, we have a trend here. We move nicely away. How far away do we move? We move as much as 40 pips away with an average range, you know, at its peak of about 15. So that's beautiful. You know, we move down. We want to see like curves. Think about when you bounce a tennis ball. If you just bounce a tennis ball like that, there's not really any momentum. When you bounce a tennis ball hard, boing, boing, breakout. There's the whole pulling back like a catapult, slingshot ready to go higher. So this example, and again, I'm just taking an example from the last couple of days. It's one, you know, that is very discretionary, but it is an example. Okay, I didn't have time to prepare a perfect example, but I'll show you one tomorrow of a really good example of an ideal scenario. We can see that we have got our one cluster. We can see that we have got our second cluster. Okay, now, if you want, you can look to into the short trade here, okay, for the continuation trade. Generally, you know, as I say, I prefer the breakout trade. Very, very weak market, you know, again, breakout or continuation you might not want to take. But if we have a little look here, you know, on the continuation, what would have happened is you would have entered into a short trade, okay. The candle closes. Does it move back below zero? No, it doesn't. So you would have got out of this trade and you would have lost 2 pips. Okay, you may have even got out on this candle. Actually, guys, I'm just trying to see which one we would have entered on. Hold on, very, very small apologies. No, it would have been this one. So we would have entered on this one. We were above zero. We would have been out and we would have lost 1 pip. So not the end of the world. Okay, and then all of a sudden we see the trend breaks. Now again, this really doesn't constitute a massive break for me. When you see when you see the breakout, you know, you want to see at least, you know, a 1 or 2 of the average true range, but not of this period here. You know, maybe of this period. You know, the average around the last few days, probably actually around 6 pips on the period. Okay, and you want to see a little bit of volume come into the market as well. You know, this is night time, it's a bit early, so maybe not the best, but we get a break. Now with this example, guys, with the breakout version, you've got to be very, very careful. You've got a choice. You can enter on a retest of the trend. Generally, I don't like to do that. I like to take advantage of momentum. The market should be going with it, you know, and if we get a good break, it can go for miles. Okay, so you can enter on the open of the next candle, or if you're very aggressive, guys, and you know, it depends. When it's night time and the volume's low, you don't want to just be entering on a break of this. You want to probably be waiting for a confirmation above the trend, you know, enter maybe on the open. Again, stop loss below, and again, Matthias, you're already beginning to make the strategy or looking at the indication. Average true range is 4 pips. You know what? 4 pips below. Maybe there's a little bit of a level. Again, discretion, use a bit of discretion. I'm happy to get in. Keep an eye on the RSI as well. Make sure not overbought. Volume is the best we've had for a while, so, you know, not the best example. We want to see good breakouts, but, you know, it's a good example that we've noticed anyway from today and last night. The trade, we can see that the accelerator at this point is at 0.000999. It moves down, but it's okay. We're still holding the trade. And again, very important, we don't move the stop loss with the trend because that increases risk. We can see that the accelerator is still higher. We pop back. And again, generally, guys, a little bit of a rule. You want to see the market have a bit of momentum for the breakout, really, don't you? Does that look like a good breakout to you guys? What do you think? You know, this is a good example of a trade. Do you think it's a good breakout? Not really, but it is a textbook example. And if you did this mechanically, you would actually have taken the trade. So, you know, it's one of those. So anyway, we carry on. We can see we're still above. We move back down. Okay, are we below zero? Yes, we are. So we exit from the trade. So we'd actually have lost a little bit on that trade. We'd have lost 3 pips on the trade, you know. But again, would we have taken the trade with big risk? No, because the momentum's there. Look, you know, a nice momentum and a break up would have been great, you know. But there's no momentum. It's night time in the market. May have lost a little bit. If you had entered on a retest, though, you can see that, well, actually, you'd have been out for a very small profit. And we're talking, you know, about 3, 4, 5 pips. But then the market does begin to turn. You can see it makes higher highs, and it does begin to move higher. So that's basically the strategy, guys. It's not rocket science. The only thing with the strategy is it does require a heck of a lot of you know, discretion with trends. So generally, if you're going to draw a trend, there's a big daily example here. Now, I generally use this on a shorter time frame, but this is a good example of you know, first to bounce, and then a continuation trade. So we have a trend line, a very good trend line. Boing, move away, boing, move away, boing, we move up. Okay, we could have entered into a little bit of a short trade, and again, I don't really want to lose my red line, so I'm going to just, let me use this one here. Okay, you'd have maybe entered on the trend. Okay, we can see the accelerator is above zero, stop loss above. You know, have we moved away a lot? Yeah, average true range is very low, 40 pips. We've away by an absolute mile. Yeah, fine. So again, the bouncing ball. We get a trade. What happens? We come off about 60 pips. Okay, so again, you know, you might decide that, you know, you want to track very tightly, and you might want to even take profit. After that day, though, I don't want to take profit there. We can see we move higher. So you'd actually exit that trade, guys, because it's a short trade and the accelerator has not made the lower high. So at this point, you'd have probably been out for about 35, 40 pips. Okay, then we carry on. And again, I wouldn't be taking the next trade here. I'd wait for the break now because, again, we haven't moved away. We haven't seen that boing. We've just seen the market doing that, which means it's eroding the trend line. We get a breakout. So then we get a breakout on this trade, and we can see that we could enter conservatively on the open. If you want to trade the break, you can generally, you know, maybe on a shorter time frame, take it down a shorter time frame for your entry level. So again, a variation is, and I haven't tested this yet, guys, but instead of using the 1 time frame, when you enter on the 30-minute, but hold it for the daily, something you can consider. We get a nice breakout, and this is of a trend we actually had in the market. This is what got me thinking about my trend line strategy again. We have a break higher. Here, we're in the trade. Stop loss is, you know, below the trend. And we look for the accelerator now to stay above zero. We move down a little bit. We move up a little bit. Now at this point, again, guys, we can see that we're nicely on side. We're about 40 pips on side. Now again, think about it, guys. You know, you haven't got to trade this whole strategy, but think about the things that make up this strategy, and maybe you can add it to your own. You know, maybe you want to look at support and resistance for profit targets. It's entirely up to you. We can see we move higher again at this point in the dollar CAD. Again, it helps if you have sentiment. We're nicely on side. 90 pips. We would have had to have had a small down day, though. We get a doji. So again, we're overbought. You might want to exit at this point, but technically, if you're mechanically, you would actually not exit until this candle here. And you can see that we would have actually exited on the close for 118 pips after being 175 pips on side. Okay, guys? So, what do you think of that? And again, bring discretion into it, guys. You know, I probably would have exited some of the trade on this doji. I'll be honest with you. And I probably would have exited some here, but I may have kept just a small amount on because we're now consolidating. But actually, that's maybe a bit of a mistake. So we move across, and you can see that bounce there. You know, we're now 0. So, you know, it's a very interesting one, guys. It can be used in consolidation. Let's try and find an example in cable. Again, we can see our channel in cable. Here you go. Look, first break of our big channel that we had in cable. Okay, it is a huge trend channel, something like that, isn't it? So we get the continuation. I don't know if this is the third point. It's always the third point, guys, as well, that makes the trend. It's that third cluster. But I think if we have a little look here, oh, we already have the third point. But okay, so let's have a little look. This channel goes back miles. So, oh, we actually have a breakout. So actually, if we take this swing high, and there's a trend. Okay, so we'll take the bad example. We won't curve fit. We'll take the example where you may have lost money as well. You know, this example, we could say, well, we would have made money, but let's not be silly, shall we? So, again, things like sentiment. We get a nice rejection candle. We get, you know, the accelerator, I believe, will be below 0 here. We get a bounce. We enter at, where are we? We enter at the high of the candle on the trend, so 98. We come down to 91. Okay, we can see the accelerator is above 0, so we're looking for it to make a lower high. It makes a higher high, so at that point, you'd exit very quickly and you'd lose 12 pips. Okay, but then you actually have the breakout. So on the breakout, you know, you can actually flip and you can look to enter long. If we'd entered long, where did we enter? It would be 160.06, so the open of the next candle. And now we're looking for the accelerator to close below 0. Stop loss below the channel. We get a bit of a shooting star. You may decide to exit, but generally we can see that market begins to move higher. We move into 0 there. Now, not the greatest momentum again. You know, it's the end of night, it's overnight. So again, the second candle may have scared you out a little bit, but you would have entered here and you would have taken all 13 pips. You know, very rarely are you going to take massive trades out of the market. They're very much short trades. And then we can see that we break back into the range. So, you know, it's a pretty good one. Let's have a little look to see if there's actually anything, maybe even on the 5-minute candle today. Just trying to find a nice trend for us. So we look for the swing high, and again we're looking for a good sort of trend, not one of these false trends, curve fitting. So swing high, we've got, that's one cluster. That's probably, I'll be honest with you, one cluster to me, guys. And this is the second cluster, so it hasn't formed. But if we get a move away, we want to see a nice move down. Bounce there. There could be one there. In cable. Again, let's move into Euro, shall we? I believe we've broken a pretty good trend here. So here we go. We've got an example. It's on the 30 minutes. So we have our two cluster, one cluster, nice big move. And then we want to see a nice bounce. We don't want to see it hanging around for too long, but we see that we get a nice area here. So we would have entered 133.42. Good thing is we're oversold with divergence. Good volume as well on the bounce. So we're in. Let's pop an accelerator on, shall we, guys? So we're in at the low, which is on the trend, about 43, we'll say. Okay, so we move back below 0 straight away. So you probably would have exited that trade. 2 pip loss, not the end of the world. So you may not have taken that trade actually, guys, as a success. Maybe when you get the hammer you decide to enter again. Looks like it's overnight, early morning. Very poor. and then we break through. Good momentum, good volume. Accelerator below 0, so you'd maybe enter, where's the close? 23, and get a bit of a hammer. And actually you'd technically still be in the trade. So you'd still be in the trade, probably looking to exit soon, and at this point you'd have been as much as 15 pips inside. You'd be rocking a 5 pip profit at the moment. Again, you might want to decide that you're going to put this in for a break even once we get the momentum moved down. Again, other ways you can do things. So you'd still be in that trade actually in the euro. Bit disappointed that the breakouts occurred near the end of the day. Would have been nice if it had been during the day. But again, there you have it, guys. Going with the trend. So, a lot of trades go on side. You might take a 2 pip loss, but you'd have been 15 pips on side. Generally, the losers, it's about being able to identify the momentum in the market. All right, guys? So, any questions on the stuff we've gone through? Anything at all? And generally, remember, I like the breakout trades more than the bounces, but that's because it's more exciting. The accelerator indicator, very, very good question. I think there are variables of it. I'm pretty sure there are other variations. But basically, if we have a little look, I've got something on it for you here. It's basically to do with the driving force behind the market. And it's basically whether and by how much there's momentum in the market. So I haven't got the accelerator. Let's open it back up. If we look at the accelerator itself, I think there are things like OSMA, things like that, combined with maybe things like ADX and that, can probably tell you when a market is volatile. But basically, when you get big moves like this and we start seeing the curve slope up, okay, that tells you there's strong bearish momentum. When it's around 0, it basically, or it hangs around 0, that tells you momentum's balanced, and it tells you that there are not very many buyers and sellers doing, maybe they're doing battle, but generally it's market equilibrium in the market. And basically, green will indicate, when sort of momentum maybe changes. So with this example, we can see we move down, okay, we're red, telling us there's bearish momentum, turns to green, and that tells you that the bet bulls have actually taken control. And we can see that here, that's not really the case, but it indicates a potential turn. So, what you're looking for really is you're looking for, when we're below, it tells you this is slowing down. So think of this as breaks. We're burning along. Oh, we're beginning to slow. We move above 0. We move very quickly back below. That's telling us now that we're in equilibrium. That's telling us now that potentially we're going to consolidate, maybe have a bounce higher, that we're slowing down. Might have a little bit of a bounce now. Make sense to you, bot? Make sense to you guys? Let me have a look, Matthias, to see if there's anything for a Gina trader that we can get. There should be. You should be able to program your stuff on there. Maybe we just need the calculation. Let me ask someone that I know who's quite good with a Gina trader. So, looking at Matthias' screenshot that he so kindly popped up onto the chart, we can see one cluster, 2 cluster. Oh yeah, I'd like that. The other thing to bear in mind is with this particular strategy, again, I always say at trend lines, best ones are these 45-degree trend lines, guys. Trend lines that go like that. Trend lines that are too steep, not so good. Trend lines that are too thin, not so good. And again, things like accentuated candles, bang, like that, very good. Things like this, not so good. We move up. You want to see a quick bounce. You don't want to see us carving around the level. You know, you want to see these quick bounces if possible. Right, guys, anyway, I think that's pretty much it from me. Find that useful, guys? It is quite discretionary, but if you can draw a trend and you can identify momentum, you can take advantage of the momentum. Right, guys, anyway, that's pretty much it from me. I'll be back tomorrow morning at 9 a.m. time, as always. Just be aware, we have got a lot more data coming out tomorrow. We've got some minutes from the Bank of England. There could be the first split that we've had in terms of rate hikes. So someone could have voted for a rate hike, which would be quite interesting. We have got Glenn Stevens speaking as well, so be aware if you're in the Aussie. As I say, this is the event of the day tomorrow, guys. Could be very important. And we've also got this as well, probably going to be a non-event. Bear in mind that we have got Janet Yellen speaking at Jack Hole. I have written a brief news piece on it for you guys. It will be on the Tradimo site. There you go. Market gears up for Yellen's debut at Jackson Hole. It used to be great when Paul Volcker was there. Likes fly fishing. They moved it to Wyoming from, I think, Utah. No, Kansas. It was in Kansas. People used to go there because you used to get comments. Not so important now, but Yellen will be testifying. Oh, well, I say testifying. One of the keynote speeches. Okay, guys. I'm off. I'll see you this evening. Bye-bye.